Chris Murphy, Susquehanna International Group co-head of derivative strategy, has been tracking the activity and joins us now. Chris, what are you seeing?
Hey, thanks for having me. So yeah, we all know about the Archegos saga by now. It's been interesting to watch over the past week. Yesterday, we saw a notable uptick in near-term call buying in VIPS, GSX, and IQ, to name a few. No doubt these calls are expensive. Implied volatility levels are high, but it's just a unique situation where you have stocks that are down so much from the highs from just about a month ago. It is an interesting opportunity to look at long calls here, particularly if you think these stocks are ready to bounce. I mean, you can argue that much of the forced selling has either run its course or been announced to the market or been digested by the market. I would point out that the call buying that we saw in these names was very near term, all occurring within the April expiration, whether it was the April weeklies, April regular, or April 30th expiration. So much more of a trade looking for a near-term bounce as opposed to a longer-term investment in these stocks.
Yeah, fair enough, Chris. And we do actually have the VIPS call option and put volume chart. So VIP Shop is a retail branded products discount that you get over the internet. And you can see that the amount of call volumes surging there. It's that yellow line as well as puts drop. Is this an indication to you that the market thinks that this kind of block selling from these trades and being unwound from some of the banks is done? Or is it still stock specific?
Well, it's a great chart to put out there because I think that it does point to investors believing that there's a good chance of a bounce. But if you truly were highly convicted that the selling was over, it might, and like I said before, volatility levels are very high. It might actually make the most sense to look at selling puts to open. So you'd actually see some put volume there. So as opposed to strong conviction that the downside is over, I think these trades represent investors liking the risk reward of the upside calls, a max loss is the price that you paid, and thinking it is an interesting near-term bet for a bounce in the stock.
Chris, when you say investors, who are you talking about?
Obviously, we've talked for months and months and months about retail trading. A bunch of the trades that we saw in these stocks yesterday were large blocks, which makes me think it's more likely to be institutional. But I think for sure we're talking about a combination of institutional traders, retail traders, which we've been talking about that combination for a long time now. But would be reiterating the point that it's a very near term, more of a trading type of a play as opposed to a longer term investment.
No, fair enough. Hey, Chris, I'm wondering, there's been some conversation that the mom and pop, the retail trades, that they're out of the market. Economies are reopening, they got their vaccines, stimulus checks are out, they're no longer trading. Are you seeing anything in the derivative market that would tell you something different?
No, I mean, we've been tracking the small lot call trading. So we're talking about call volume, actual trades that are 10 contracts or less. And we have seen a pullback in the volume there. Now, I would point out this is a pullback from, January extreme highs with GameStop and things like that. It's still a lot higher than what we had seen for pretty much any time before that. I think that the reopening argument is certainly a strong one. I would also just point out that volatility levels are lower, and intraday volatility has been lower in a lot of stocks in a lot of situations. And when you have a decaying option, it takes a bite out of those call positions, and lower realized volatility, lower moves in the underlying stocks also makes it harder to monetize call positions. So, it might be a situation where, sure, the economy's reopening, but also it's becoming harder to make money in these short-term call trades because volatility is coming in.
Is that what you're seeing more broadly? The momentum starts, as you're kind of alluding to, is dropping out of this. And I'm wondering, we spent a lot of time getting very excited about gamma squeezes and the impact that was having as we saw basically these positions being covered, and that was pushing the market higher. Do you get a sense when you look at the index levels that again, kind of we seem to be in a kind of hiatus right now? I'm just wondering whether that is the effect that we're looking at here.
I was never a big proponent of as much of a big component of the gamma squeeze, just because so much of that retail call trading that we were monitoring was opened and closed in the same day. We knew that because the volume number was significantly bigger than the open interest. So we had been kind of making that argument that sure, it has having an impact, but when you're buying and selling the same call in the same day, the not even long-term impact, the impact over the course of a day or two is really much more muted. So I think it's real interesting to see some of the frothiest aspects of the market, whether it's individual stocks or just kind of euphoric retail call trading coming out. But the S&P still near all-time highs. Probably a better risk setup for equities in general going forward when you can take a little bit of the air out of some of the bubbliest sectors.
So what's the best way to hedge that? Like, what's the cheapest way to hedge that right now?
Just looking to hedge a pullback or the S&P moving higher.
Pullback.
We've been looking at put spread collars. So just to go through it really quickly. So you have a situation where volatility is in a lot, but the wing options, so the downside put options and the upside call options, volatility has remained more bid there compared to the at the money options. So what you would look to do in terms of the hedges, you'd look to be buying an at the money option. So let's say an S&P a put option, but then you would finance it by those wing options that have been a little bit higher, a little bit stickier. So you would be buying a call spread and buying a put spread and selling an upside call. And you would cut down on your cost, and you'd also take advantage of an interesting dynamic in the options right now where at the money volatility has come in a lot, but the out of the money call and put volatility levels are still relatively big.